Welcome to the From Code to C-Suite podcast.
Roughly 46% of the professional layer of our population is self-employed. Tongo is basically believes that the financial system is built for people on salary and the companies that employ them, and that is a huge problem.
Today, I'm sitting down with Brandon, co-founder and CEO of Tongo. We are breaking down the hidden financial traps of being self-employed, why credit scores are failing millions of people, and the brutal reality of starting a venture-backed business. Let's get into the conversation.
And I know that there's this sense that, these are risk takers, but I actually think the opposite. Never be in middle management. It's the first to go.
You can actually grow to despise your passion, right? If it doesn't
Exactly.
work out. Brandon, good morning. How are you today?
I'm well. How are you, Liam?
Very good, thank you. Great to have you here. I know you're a super busy guy, so I really appreciate the time.
Yeah, vice versa. Thanks for the invitation.
Very welcome. Good to catch you while I'm in New York. For anybody who doesn't know, could you please give us an introduction of who you are, a bit about your background and what you're working on today?
Sure. So, present tense, co-founder and CEO at Tongo.
Nice.
Tongo is basically believes that the financial system is built for people on salary and the companies that employ them, and that is a huge problem because, especially post-pandemic, roughly 46% of the professional layer of our population is self-employed. It's easier to be self-employed than ever before. I think there's an emerging belief that AI is going to allow people to be, even more self-employable, to invent a word. But the problem is that self-employed people get paid in irregular ways. And if you think about the monthly financial economy, you have all of your bills due every single month, whether it's your mortgage, your cell phone, your gym membership, health insurance. And that more or less assumes that you can pay those bills because you get paid every month. And that's a salaried construct. But that's not true for roughly 36 million people that have self-employed income that get paid when deals close or get paid when they generate a commission. And if you believe that that success in financial services is largely based on cash flow alignment, as we do, then you kind of need to rethink how you build financial services for people with irregular income. Just think about the business line of credit you don't have to repay until you get paid. Saving also happens in the flow of funds. So that's a little bit about Tongo. Now, in terms of how we got here, so for the last 25 years, I've been kind of in and around financial services with a few footnotes. I started a coffee shop when I was 24. Just before that, I was in Smith Barney as an analyst.
Nice.
The coffee shop was me really thinking that I was capable of starting a company because I drank a lot of coffee, which is not always the best reason to start a business, but it was a lot of fun. Started a mortgage company. That was if being at Smith Barney was a front row seat into understanding what successful savers looked like, then being in mortgage was a front row seat into understanding how people qualify for credit.
Yep.
Who lenders want to lend to, who they don't want to lend to. Did a bunch of things the hard way. I think I had an idea that I would throw myself into the mix in my 20s, learn as many lessons as I could, even the hard way. And by my 30s, I would have learned enough, made enough mistakes that I could really capitalize on those and start, generating some success. It took a little bit longer. I think what happened was I realized that I was making all of these mistakes and learning all of these lessons the hard way. And whether it was the coffee business or the mortgage business, there were certainly common threads, but there had to be best practices that I could just learn. I just didn't. Not everything has to be learned the hard way. So I ended up kind of a friend and mentor at the time was an operating partner at Vista Equity Partners, which is the largest software-focused private equity firm in the world, but it was earlier stages. They had this kind of suite of 50 to 60 best practices that they would apply to SaaS businesses that were really sticky. That sounded super interesting to me, that they had this kind of codified lessons learned that could be applied. So ended up going to Cornell for business school, what I hoped would be en route back to Vista. once I got to Cornell, I met my last co-founder, and we ended up building a business called Catapult. And that business was really based on, hey, we just come through the credit crisis.
Yeah.
Being in and around mortgage at the time, I recognized how much lenders had indexed to credit scores as a means of qualifying or deciding whether somebody was, well equipped to absorb a $500,000 mortgage. Everybody knows my favorite loan, and probably the best example of which of kind of underwriting standards getting relaxed and over-indexing to FICOs. If you had a good credit score, but then a lender would potentially let you apply for what they call a ninja loan, which is no income, no job, or asset verification.
Oh, okay,
so
nice.
you know almost nothing about these people, right? But you do know their credit score. When good people when high credit score people started defaulting, that's when things went really sideways, right? Because there was this recognition that lenders were that data point was failing, and it was like, okay, there was almost this baby with the bathwater moment as far as we were concerned. So we were basically trying to use AI in 2013 to build underwriting engines for lenders. It was too black box, but what we did do is we decided we were good at underwriting where data was messy and hard to understand. That is the non-prime problem in America. So it turns out that as you get kind of farther below a 700 credit score, there is a correlation between creditworthiness and score, but it gets looser. The problem is primarily that people don't have the right data in many cases. They're cash preferred, they might be an immigrant, they've only had one or two trade lines. That's just not a great, you don't have enough data to have great confidence in a credit score.
Nice. Sorry to jump in there a little bit, but I know it seems like you've kind of gone through the different stages, right, to get to where you are at Tongo
That's
today.
Exactly right.
So you're doing about the credit, you've been in fintech for such a long period of time.
Yeah.
I really want to hone in a little bit more on Tongo and exactly what you're building there, like what the customers look like, and so on and so forth. So tell me a little bit more about that. How long's that been going on for? What does the business look like now?
Tongo is a recognition. One of the things that we learned at Catapult was that if you took somebody who wasn't performing, paying on time, and you asked them I should step back. We started billing everyone monthly, right? That's just how the world worked, we thought. But if you started asking people that weren't performing when they got paid, which was probably irregularly, and then you set up a repayment event within, call it 48 hours of that income event, they started performing like high score borrowers, if you will, right? That kind of helped us pull back and say, what is one of the largest problems in fintech that we don't think has seen much attention? And I think we decided to, blow up the sandbox of the data available and just ask the question about who's the financial system built for, and is it possible to kind of reframe this for people that get paid in these irregular ways? And one of the metaphors was kind of this, if you think about like the Old West in the company store, people would go in, they'd get flour, they'd get whatever, saddle, whatever they get, but they'd repay when they got paid.
Yeah.
They'd come back to the store,
Keep it on
right?
tab,
And so this proprietor kind of had this like mental model of, I know you're good for it. Well, as banks scale, they want to homogenize processes because it's cheaper and more efficient. And I think that's where we landed with this monthly billing cycle.
Makes
and now
sense.
we've got secondary markets and all of these things that like structurally want you to kind of live by that monthly system. But I think we're at the beginning of recognizing that for a huge portion of the population, there is no budgeting app, there is no monthly construct that's going to help them succeed. Or if you believe that financial stability is kind of the basis on which you build a successful business, you need to think about how you align cash flows, and that means kind of starting from scratch.
What would the typical customer look like? I know we mentioned before, like real estate agents or commission-only workers. Is that typically the case? Like, who else would be?
It is. So if you think about like basically where do you start, and where do you start from a product standpoint? Where do you start from an ecosystem standpoint here in the U.S.? So what you would do is what we said is, okay, look, there are 36 million self-employed professionals. It turns out that if you look at where there is density, real estate is great, specifically residential real estate. So about 6% of that population is residential real estate agents.
Yeah.
And they make a lot of money, but they have these very chunky commissions. So think about 2 million agents that earn roughly $120 billion in commissions every year.
Yeah.
The average agent, and of course production is barbelled, but the average agent's going to close about 5 deals a year.
Yeah.
And they're going to earn somewhere around $75,000. So,
and that's completely sporadic throughout the year, right?
Completely, yeah. 5 income events, 12 expense cycles, right? And when I say that there is no budgeting app that helps them kind of stabilize, there's two kind of issues. One is the chunkiness. Two is they don't actually know when that next income event might happen, right? You close a deal, the next one might be 60 days away. It might not be 90. You just don't know, right? So kind of the premise for us was like, if credit is based on looking backwards, what happens is you'd say, yes, you'd look at other data, but you'd more or less say like a credit score is a huge variable that will tell you whether someone has been successful making past monthly payments. Some other public record stuff, but let's just say that's what we're primarily looking at. The challenge with the self-employed professional is that because of that lumpy income, it may not be an accurate reflection of whether they'll pay a bill. It just might be whether an accurate reflection of whether they'll pay a bill monthly.
Yeah.
Right? And so what we did is we said, look, we actually need to size against your future cash flow, right? So if we have the data to understand when you'll generate another commission, and that data has integrity such that we can say, okay, it's actually this particular transaction, and there are public records around it, and we can consume it, and we know the size of the commission, and we can build a relationship with the payer, which ultimately becomes distribution, the brokerages where those agents work. Yeah. Then we can give you liquidity that's priced like your. It's a better reflection of your credit worthiness than looking backwards to understand whether you're a successful monthly payer.
I think it's great because the thing is, right, and let's say, for example, a successful real estate agent might earn a few $100,000 a year. Yeah. They might struggle to get a loan on something or maybe credit on a phone contract, gym membership, whatever that may be, because they don't have that monthly recurring revenue, I guess, in their bank payments. Yeah. So somebody that maybe earns $60,000, $70,000 could get that access to that, but somebody that earns a few $100,000 a year couldn't. Yeah. Because it doesn't make sense to what the system normally operates on.
Yeah, I mean, there's so many problems. I mean, we in an earlier conversation, I told you it's like sometimes it's, these people are running businesses, right? They're building businesses, and because one of the statistics that's like shocking to me as we kind of got into this is, so all businesses need liquidity, right? Mine included. So we raise venture capital. That's one of the ways that we've funded the business. And once you're profitable, you may yet raise more capital because you have your growth expectations need to be funded. If you are self-employed, if you are a real estate agent specifically, you have monthly expenses. You have subscriptions to tools that you software tools. You might have a transaction coordinator. Certainly, you need to be marketing to build pipeline. And what happens is if these folks don't tend to qualify for business lines of credit because one, they're like self-employment. The way that you show your income is completely misaligned with your ability to get capacity if you're applying. So let's just say you make $75,000 a year. You have all these expenses. You're self-employed. You might be an LLC or a sole proprietor. You're going to write off a bunch of those expenses against your income. The lender's going to underwrite your taxable income, which is going to be less than your gross. They're going to have a lot of questions on whether you can repay a business line of credit if you generate such little income. And by the way, it's highly irregular. And by the way, your credit score might be suppressed because you're carrying 3 times the credit card balance of the average American because you don't qualify for business lines of credit, so you've been funding your business with your personal credit cards.
Yeah.
Those high balances suppress your credit score, but also maybe you had to make some tough decisions on what you pay when you pay it.
It's a complete catch-22, isn't it? Because then you're only going to ruin your current credit score if that's the case.
Totally.
What would people actually do usually if they're in that position and they've not got, for example, the access to Tongo? What would they do? Would they just get themselves in debt, or
They do one of two things. Either they get themselves in debt or they go without.
Yeah.
And both are problems.
Yeah.
Right? So the get themselves in debt piece goes back to the you're funding your personal your business with your personal credit. You have all of this conflation of these two things, which is not great. There's a data point out there that real estate agents overpay their taxes by $1,500 every year.
Really?
Because they can't parse their business expenses from their personal expenses. They basically aren't writing off enough. The other thing is just going without, and this is what we talked about in a previous conversation. Like when I was in the mortgage business, I remember a time when, I wanted to propose to my wife. I'd made that life decision, and I had the ring.
Yeah.
I should say the woman who helped me design the ring had the ring, waiting for me to deliver her a check.
Yeah.
I couldn't deliver her a check for over 60 days because that's when my
Commissions
would come through, right? That's a life event. Think about like all of the business expenses that you might have incurred, that you need to incur, by the way, to avoid the feast-famine cycle of, commission, nothing. So in order to stabilize cash flows, I think the argument is you need consistent investing in marketing, in building, in funnel management, and all these tools, but you don't have the cash flow to do it. So the way that we've tried to address that is to say, look, like let's give you one, in real estate there's a lot of data, right? There's also distribution if you can strike the right alignment through the brokerages that kind of house the agent pool that are interested in agents growing their business, especially if they're self-aware of the problem that every year agents have these business meetings, these business plan meetings with their broker. This is what I want to do this year. Great. The question they should be asking is, how are you going to fund that stuff, right? Because they don't have a financial toolkit, and that's
it affects their performance as well, right? Because they've not got the confidence to maybe go and spend on the marketing because they don't know when the next commission check is going to come in.
Exactly.
So they can't actually progress. So if they know the confidence of being able to afford that, they're only going to perform better, you would have thought anyway as well, right?
That's right, totally. So what we find is that there is this credit arbitrage that the market is not that we're benefiting from. That the market is not just the fintech ecosystem, I think, is just beginning to appreciate. It's this question: do we have the technology now and the data availability to customize the repayment timing of liquidity? And we're taking it vertical by vertical, but within real estate, like the answer is yes, we figured that out. There's this other thing though that we're really excited about, especially in 2026, which is if you really want to build kind of the essential financial platform for the self-employed, which is kind of a big umbrella idea. How do you start? And we started with liquidity because the idea is it's really difficult. So let's just say you can almost think about it like, what do I do before I get paid?
Yeah.
And then what do I do when I get paid? And those are kind of the two inflows and outflows. You can bridge it by basically saying like, okay, before I get paid, I need access to liquidity because I need to keep reinvesting, on my, throughout my commission cycle.
Yeah.
Once I do get paid, how do I manage my finances? Because you want to accrue some wealth over time, but it turns out self-employed people are terrible at retiring.
Yeah.
Right. In fact, there's this adage in real estate that real estate agents they expire, they don't retire. Right. It turns out that saving is also a salaried construct. Right. So there are kind of two primary places people keep their wealth in the United States. One is the equity in their home.
Yeah.
And two is their IRAs or their 401ks, right? 401ks are a salaried construct for the most part, at least the way it's executed, right? That because those are passive contributions in the flow of funds of payroll. If you get paid with ADP, Gusto, Rippling, etc., then you log into your payroll system. You have open enrollment for health insurance. You choose how much you want to contribute to your 401k. You kind of set it and forget it. You probably don't log in for a while after that. And it's great. So the heavy lifting of budgeting is already done for you, right? Your insurance is funded. Your retirement account is funded. If you're self-employed, if you're a real estate agent specifically, when you do get those commissions, you get paid your gross.
Yeah.
Right. And then you have to figure out, if you want to be a good saver, you have to figure out what types of accounts you should have, where to open them, how much you should set aside, and then you actually have to move the money every single time.
It's hard work, isn't it? And also, I feel like I'm thinking of young, maybe like young brokers that are getting into the industry. They probably need this quite a lot because they've not built up this reputation of a consistent business, etc. And these guys maybe aren't financially educated enough to understand that properly.
Totally.
I'm thinking of people that I know. It goes two ways, right? They'll either hit a big commission check and they'll save it because it's like their scarcity mindset, or, oh my God, I just got a big commission check. I'm going to go buy a watch. I'm going to do another deal next month. And it might not happen.
Yeah.
So there's kind of like the two mindsets around that, isn't there?
Totally. There's this, I mean, if you think about why you start businesses, it's, let's just say within real estate. Well, I'll tell you, like the coffee shop.
Yeah.
I started the business because I really like coffee and I thought I'd be drinking coffee and I wanted to be around that coffee vibe all the time. Turns out that's not what I was doing at all.
Yeah.
Right. As a founder, I was hiring and firing.
Yeah.
I was trying to make sure my teenage employees showed up. I was doing quality control. I was thinking about inventory turnover, or figuring out where I could get, scones from, because I was like
out of
way
interest
late
on that. People say like follow your passion, or that sometimes that's an amazing thing to do, or amazing to not. Do you feel like from your experience that's good advice or not good advice?
I think it's great advice, but I think you not recklessly.
Yeah.
Don't be reckless. People say like, I think the question is, what do you want to do, right? If you really like consuming coffee, you should consume coffee and go down that rabbit hole. If you want to run a business and you like the idea of creating something, and you are not intimidated and fully expect to make loads of mistakes, that you're just gonna have to grind through it. I think you just have to have all that persistence,
because then you can actually grow to despise your passion, right? If it doesn't work out.
Precisely. People get into real estate because they like real estate and they like people. They don't get into real estate thinking, I really want to manage my funnel through a CRM. I really want to live in my transaction management system, and I really want to be a CFO, right? So if you're self-employed, and there are lots of people in real estate that have built teams to delegate some of these functions. But really, you are your own CEO, CMO, CTO, CFO, all of these things. Yeah. I think the CFO piece gets diminished especially if you are a seller and you're gregarious. You have to be optimistic and you have to be a grower. And so there's this sense that if I'm financially behind, I just got to close more deals. Right? Yeah. As opposed to, let's pull back. Why am I feeling financially destabilized? How do I kind of moderate these highs and lows? I think whether you're a top producer, and top producers use Tongo because they appreciate growth. They know they need to be investing, and they want to keep business and personal separate, like a business should. People that produce more moderately use Tongo because they're feeling that feast famine. And they just want to get off the roller coaster. Right.
But also people, I guess, like if it's an individual single person, maybe like revenue, what's the phrase? Like revenue diminishes all issues, right? Because you can kind of live that way.
Yeah.
But then when it comes to, if you've got a family, you need a bit more stability as well. When maybe you're sending your kids to school and there's payments, like it's a different mindset you've got to take on board as well.
Yeah, and when you said like kind of what do people do, I think that's where, you know, when there are other people involved, especially when you're running when you have a family, that cash flow stability is so critical. The conventional wisdom is, hey, estimate what you'll make for the year.
Yeah.
Figure out some budget that you can live on that is a much smaller number than what you expect. Pay yourself out in a salary out of that smaller number. It's just not always realistic.
Yeah.
Right? It's just very hard, which is why that advice doesn't get taken very much. So, you know, pulling back, I think what I love about Tongo is that it's kind of a root cause problem. Whereas Catapult might have been like, do people need consumer durables? Do they need to pay monthly for expensive things online? Absolutely, right? But it wasn't a root cause. You know, Tongo is like a root cause issue. You need to rethink how people are, how liquidity works, how repayment works, how savings works, and then you need to do that at scale.
It's complex. It's a lot more complex, right?
It's a lot of fun. I think that I'd say we probably spent 3 years getting our unit economics right, understanding how to make money on an advance that works like a line of credit, that is priced aggressively like a loan, right? Because with an advance, you can divorce yourself from that monthly construct. You could repay in 22 days or 58 days, right? You don't have this like make a minimum payment or make a full payment every month. So with an advance, you just have that flexibility, and that is the best product for someone with irregular cash flows, right? But saving is a little bit interesting because in order to save, it's not telling people that they need to save. Everybody knows that. It's automating it. And the only way you can automate it is if you own the payments infrastructure within the flow of funds. So what we basically did was we said, look, let's kind of look at what exists as a framework. No need to reinvent. If people are really good at contributing to their 401ks within payroll, can we build the payment rails so that when brokers distribute commissions, they're distributing commissions through Tongo?
Yeah.
And with those rails, can we basically allow anyone who's self-employed to connect multiple accounts in the flow of funds, just like you would with a 401k or health insurance or an HSA or whatever, and then give you control through a dashboard to be able to say, okay, I want to save, I want 27% to go to my high yield savings account. I want 8% to go to my solo 401k. I want 3% to go into my marketing account, and I want the rest to flow into my business checking.
And that's all on the dashboard, is it? Like
it's on the dashboard.
That?
Yeah,
Nice.
You can connect 20 accounts, right?
Wow,
and
cool.
then, but importantly, because you have irregular cash flows, if you're salaried, you know exactly how much you're going to get paid every month. You can set it and forget it. You can set it and forget it because it's known. If you're self-employed, you're going to want to save more or less depending on what you've closed recently. So you need to be able to go into that dashboard and change it every day. It was 27% to taxes on my last deal. Now it's going to be 3%. Now it's going to be 5%. Sometimes it's 0%, depending on where you are, right? And so that flexibility is like price of admission for somebody who's self-employed. It's got to be super simple. What we're doing now that I'm super excited about is kind of building the product that takes us this kind of vertical agnostic, which is condensing these things into a digital wallet that which is where everything kind of should and could live. So if you get paid with Tongo, then yes, you can kind of automate those distributions, which is really budgeting automation. But we now have the right relationships where I can kind of offer you a business line of credit that is an advance, but we can dynamically size that based on known production, right? We can help you get access to insurance because this is kind of your financial hub. We can We can introduce you to things that you need, that you've historically had to source on your own, that makes sense to be in a something that's kind of at the intersection of payroll and liquidity.
Makes sense. How do you typically market the product then? How do you get it in front of real estate agents?
Well, that's the funny thing. So, like I mentioned, we're 5 years in, and for the first 3 years, we were super targeted. Well, we had to figure out all sorts of things, like right? You come into a market thinking you know how it works, and then you realize you don't, right? Initially, we went direct to consumer, and then we realized that in financial services, especially if you're doing something that has a balance sheet, there were some really important lessons learned in the teens, and I suppose throughout history, but specifically in fintech. And one of which is that if you go direct to consumer, if you don't have a moat of some kind, then there's a risk that your cost of acquisition could blow up as other entrants come in.
Yeah.
What I took from my experience in buy now, pay later was that button in a shopping cart, that integration is a little slow sometimes to win it. But once you win it, you have a switching cost.
Yeah.
But what we also wanted to do was, if you're building financial services for underserved populations, you need to be able to price the risk. But we really wanted to be part of the solution, not part of the problem. And in order to price aggressively and build a moat around your cost of acquisition, you really need, in my opinion, a B2B2C model where that alignment you have with the middle B starts to act a little bit like a moat and switching cost.
Okay, nice.
And that means that, and so for us, that means that we wanted to integrate with the brokerages and the tools that agents use to distribute this financial solution to agents. That's a hard problem, and it took us some time to figure out and I think that one of the reasons that 1099s are just generally underserved is because it's this long tail. It's really hard to efficiently distribute to them, right? And so, getting that alignment right with the brokerages, with the tools, was really important. It's not the liquidity piece that brokerages really latched onto, because if somebody's in a place of financial distress, they don't really want to talk about it.
Yeah.
You don't
hide away from it a little bit.
Exactly. Nobody's gonna. I mean, there are people that do it, and God bless them, but most people, there's like a shame associated with that, right? Like, I've done something wrong. And so for us, within our branding and marketing, we've tried to help people understand that you're not doing anything wrong. It's just the financial system's not built for you.
Yeah.
We have to rethink that. We sympathize with this pain of irregular cash flows and all of the downstream consequences of volatility. We're going to start with liquidity, because stabilizing your cash flows should support budgeting. Once you budget, you can start thinking about saving. Let's automate saving and make it super easy. And then let's bring those two things that feel separate into one place where you can start to think about kind of holistically managing your business finances.
Even for the brokerage, though, I feel like it's quite a good selling point for when they're looking to hire new brokers, because if they've said, look, we're partnering with Tongo, who can help you with your finances and so on and so forth, your credit, not every brokerage is going to offer that. So I feel like that's also good for those guys too.
It's super good. And basically, if we recognize that the average American has 3.9 credit cards in their wallet and about a little over $6,000 in monthly credit card debt, right? The average real estate agent, as we see in our data, has 50% more credit cards.
Wow.
And they have almost 3x the credit card balances, right? And so, but brokerages don't see that. They don't pull credit on their agents, and the question is, what would they do even if they did?
Yeah.
So to go to brokerages and to say, hey, your agents have a financial problem that you don't see, but this is an important tool in their toolkit. That lands, but it's not it's not ubiquitous. Like not everybody gets it. But if you were to say, hey, a lot of saving is best, happens best in the flow of funds. And when you pay agents, you pay them gross. And by the way, like you bring people in every week or every month into your meetings, financial planners or, insurance agents or what have you. And you're reminding people of the need for financial stability. How often do people walk out of those meetings and have like, radically different financial behaviors?
Yeah, they probably feel worse about the situation.
Yeah, almost never. And also if they look at their agent roster, they see that people are selling real estate, oftentimes into their 70s, or there's a lot of churn because they go back to their salaried role because they have a hard time tolerating the financial stability. And it's a little bit easier to say, look, distribute commissions the way you always have. Just use us. And then downstream, we're going to offer this suite of tools that makes it super easy for agents to automate saving so that when you bring those people in, now they have a way to kind of action that recommendation from the financial planner or whatever.
Yeah.
And by the way, if they have a gap in cash flows and they need to keep investing to avoid that feast famine, they have access to this liquidity that, by the way, they don't have to repay until they get paid. Like we're not going to ask them for a minimum monthly payment. That starts to land in different ways. And now we can build upstream tools for brokers to do the same. So I think being in the flow of funds has been a big unlock for us, just because it's an easier problem for brokerages to see.
Yeah, makes complete sense. No, I love it. Back to your story a little bit now as well. Like in terms of being an entrepreneur, is that something you think you always had in you? You've obviously had the coffee shop, you've started multiple businesses. Was that always something you had in you from growing up? Like how do you think that is? I mean,
I think some of the character traits that entrepreneurs need to have, for sure. I've had to actually talk about, like, one of the things when you apply to business school, you have to write about what you want to do and why, and that was a forcing function for me to kind of answer this question. And I think what I wrote about is probably true. There's a couple of things. One is when I was 13 years old, we had my family. I grew up in the Seattle area. We moved from kind of south of Seattle to east to Redmond, where Microsoft was just emerging. This was like 1989, 1990. And we had lived in this like 27-foot, I think it was 27-foot trailer, watching our house being built for like 9 months. Yeah. Family of 4. And my parents were young, 19 and 20 years older than me. But this was like their dream house at the time, and we were. It was a pretty cool experience. Well, we move in, and just then, which was a blessing in disguise for him career-wise. We didn't know that till later. But what happened was he lost his job. Wow. My mom was working at Nordstrom selling cosmetics, and my dad was helping manage a container yard, making $34,000 a year.
It's not ideal when you're just getting a new house.
Just lost his job. Like we were like weeks in. Wow. And I remember that stress was so palpable, and he said something that he probably thought was just out of the side of his mouth, but he said, "Never be in middle management. It's the first to go." Yeah. And so for me, well, that's one thing. The other thing that they used to say, they were very encouraging parents. They're like, you can do it. You can do anything you set your mind to.
That's important. That's good.
And I think between those two things, what I realized was, my kind of internal dialogue was, I can do anything I want. And by the way, there's huge risk going through the middle of any organization. So when I was 22, I had a job as an analyst, but nobody was going to hire me to be the CEO of Smith Barney. And I realized, and in the back of my mind, I'm thinking, that's where the risk is. So who's going to hire me to be a CEO? Probably just me. Yeah. So I should start my own company. I think that I'm so inspired by people that make that choice to start businesses, and I know that there's this sense that these are risk takers, but I actually think the opposite. I think that, for me, the way I think about it, and I don't mean to get too heavy, but for me, it's not the risk in the moment that I think about. I don't want to be at the end of life, if I'm conscious, to look back and think that there was something that I didn't do I could have done.
Yeah.
I don't want to know. I don't want to not know that, right? And so for me, the risk is not being able to answer that question in a positive way.
It's a scary thought, isn't it? I remember we spoke about this before, and I think exactly the same. Like, I would hate to look back and feel like it was wasted potential.
Yeah.
I'd rather fail and then realize at least I tried, you know?
Yeah, and I think like once you do it, I mean, thank goodness I was young when I started that coffee business, because you have a lot of time to recover.
Yeah.
I mean, that was a messy thing. I had lawsuits. I was taking out second mortgages to fund this thing. It was like
at 22, that's heavy.
Well, I was trying to defend a lease, and there are all sorts of. But it's like the thing is that. I mean, that was a low. I mean, to this day, my wife says like that was your coffee shop, not our coffee shop. You know, but you survive that. I do think that entrepreneurs now, especially in venture-backed businesses, funding is a signal. Getting into an accelerator is a signal.
Yeah, for sure.
You know, just like going to a good school in college is a signal. You have to, as much as you know, raising venture can be challenging, and having the wrong investors around you is a nightmare. The process of pitching and learning that language of venture and having the benefit of that feedback. I mean, VCs collect business models for a living, right? And they think a lot about what's next, and having to kind of pitch your idea, get that feedback, and bank it up against somebody who's thinking about it. That's just really helpful.
Yeah.
But I think that people that, you know, at least the folks that I surround myself with or tend to be surrounded by right now that are starting companies, the risk to them is that they don't start for maybe one of those reasons that I mentioned, but also they spend so much time de-risking the opportunity, right? They're thinking about why this product doesn't exist. What are the market dynamics that have kept it from existing? I think it's super important to always ask that question, why now, right? Why hasn't somebody done this? And even then, when you ask all those questions and do all of that de-risking, you feel pretty confident that this is going to work, knowing that as soon as you get into market, you're going to be super wrong, which is why you have to surround yourself with those great 100%. People.
100%. Do you think it gets easier? So I guess I mean easier when you start a new business or you've gone through that tough time, because at 22, if you think about it, most 22-year-olds these days, or most 22-year-olds generally, you might have still be at college or playing video games all day. You've actually had a business which fortunately has failed, but you've handled lawsuits, like credit card debt, everything. Not many 22-year-olds have put themselves through that pressure or stress before.
Yeah. I think you certainly build up muscle memory.
Yeah.
You know, I would argue, I actually said this last night when I was speaking to a cohort of entrepreneurs. One of the reasons I started Tongo is because Catapult was such a mess. You know, it was like 3 startups in one. I mean, it went public as a unicorn. So for folks that are listening that wonder if it can be a mess and also have a great outcome, that's entirely possible, right? And I hope that's true for many people. But you know, I think that's just the job. Like if you're somebody that wakes up every day and says, I like to solve problems, and sometimes they're the people problems, which are super hard. Sometimes there's market problems. Sometimes it's, you know, the sales cycle is too long, but it's probably too long not because you have the wrong people, because there's something wrong with the product. You have to question your assumptions. Some of the times that we get things the most wrong, it's because we've made an assumption that wasn't explicit enough to recognize, and we needed to compile a bunch of market feedback to understand our own poor assumptions. I think you get better at recognizing those things over time.
What do you think some of the biggest lessons you have learned starting multiple businesses like?
Different stages. So the first lesson I learned, I think pretty early on in my career, was your co-founders need to be very different from you.
Yeah.
You have to have the same common thread of values, or else you won't be able to predict one, I think the chemistry is going to be off, but two, you won't be able to predict how they behave when things get hard. And so, they don't have to be the same sex, religion, gender, any of that. I guess sex and gender are the same. But they have to have the same values. The complementary piece, unless I also think about opportunities as a bit of a radar, right? It's this unknown thing. You and your skill set can kind of illuminate like this triangle, and unless someone's different, you're not going to understand what the other 3/4 of the pie has coming. And so you need people that can kind of de-risk different aspects of the business.
It's really difficult though, isn't it? Like, even when I was starting our business, I really would like a co-founder, to be honest. But the only people that I knew was in the same industry, the same skill set. So it didn't really make so much sense.
Yeah.
But it's also nice to have that person with you at the same time. Do you think if someone is starting a business, would you recommend them to have a co-founder if they can?
I have like enormous respect for kind of solo founders.
Yeah.
I think that's so hard. I actually think it's so hard because you have to be good at so many things, so credit to you. For me, I'm only good at so many things, So I needed, and I think being self-aware is just like price of admission. Like if you're a founder, and I mean, so many ways that this goes sideways. If you're not self-aware of your strengths and maybe more importantly, your weaknesses, then you can't bring people on to balance you out. But again, back to the values, you need to have the same work ethic.
Yeah.
You need to have the same tolerance when things go sideways. You need to have the same kind of. You need to be aligned on the vision, but yeah, I just think it's. Actually, there's this other thing that's been happening. My first business, I had one. My second business, I had one, but fast followed. Actually, I had two. This business,
Co-founders talking about, right?
Co-founders. This business, there were 4 of us, and as a you got to split the equity pie up more ways, but I think I've gotten better at your original question of like, does it get easier? I've gotten better at pulling back, especially within fintech, and saying like, okay, this business has a balance sheet component. Like, understanding our unit economics was a huge pain last time. We have to have a chief risk officer to start this business. That has to be day one. So my friend John, who's has been in credit for over 20 years, that's his drum solo. He's very talented. He had to be there day one. We had to have Luis, my co-founder, who's our CFO, but is capable of wearing lots of hats. As I self-identify, he was there day one. Patrick, our CTO, right? We needed that component. I think that I brought more people around me just because the easier part for me, the way that it's gotten easier, is I think I have a better view of who needs to be there, who's essential earlier on, and I'm happy to split up the equity pie if that means we've de-risked the business.
I think that's really important because, especially like you said in fintech, if you have not got the compliance guy, it's very difficult. If you haven't got the CTO, it can be very difficult. And if you're a solo founder, to bring those people on board to that caliber, if it's a solo hire that you're doing, it can be very difficult to attract that talent at the same time.
For sure. And I think they need that. Like, those were also people that I needed to represent to, our investors that we had. Like, what did you learn from Catapult? Like, that was a question I had to answer. At least I had to answer it for myself. Otherwise, why would I do it again?
Yeah.
And I think it was this problem that we were working on before was unresolved. And I think this is more root cause. It's going to be a hard problem. I need some super smart people around me that are, also motivated by solving a problem and have a big vision. But those skill sets were just going to be core. And I think in the last company too, I had this idea that technology would kind of solve all problems, right? Technology you can underwrite with AI. You can build repayment with AI. You can do all these things, and technology is awesome, but there are certain functions that technology can make better, but will not replace.
Yeah.
And in financial services, managing credit risk is just one of those things.
Yeah, makes sense. Obviously, you've been in fintech for quite a while, right? So you've seen the industry change a lot. What would you say the biggest trends that you've seen change over the last 5 to 10 years?
So, you have, I think especially coming out of the credit crisis, I'll go back a little bit farther and then I'll come present.
Yeah.
You had a lot of banks with pie on their face. And then you had a bunch of people that were looking around at the time and saying, hey, I think I can do non-prime credit better. Hey, I think I can do, there's this huge population that is going to payday lenders and paying exorbitant fees in check cashing or very short-term bridge loans. I think I can do that better. We've got, deep learning in the early teens. I think that I can use a bunch of data from these newly emerging alternative credit bureaus that were not Equifax, Experian, or TransUnion, and I can find all that weak signal in data. We have algorithms and models now that can digest many thousands of data points, build it into a score that I can use in risk decisioning.
Yeah.
All of that stuff kind of allowed us to chip away at these underserved populations in different ways.
When was this? Sorry, because I know we spoke about it before. Is this like post 2000 and 2008?
Yeah, so like there was a company called Zest Finance that was a former Google employee that wanted to kind of reimagine risk scoring for credit for underserved populations, right? So like roughly 46% of the population has a credit score below 700. We had that started to get lenders thinking that they could extend, credit to those populations because now I have better data.
Yeah.
And then you started thinking about like, okay, e-commerce is emerging at the time. Where does financial services interplay with e-commerce, right? It turns out that a lot of people, this is my hypothesis, a lot of people, because Americans are not great savers, they tend to use their credit card capacity as their emergency fund.
Yeah, yeah.
So when they go to a website and they're looking to, they go to Wayfair and they need $1,100 in office furniture or whatever, if there's a way for them to finance that inexpensively through a firm or Klarna or Afterpay, they're going to do that in order to preserve that emergency fund. They're going to get incremental credit, right? Especially if it's pay over time, if they can stretch it out. So you had this risk modeling capability that allowed you to find weak signal. You had a lot of real-time underwriting decisioning that could be deployed in interesting places where you needed very quick turn decisioning, like e-commerce, right? I need to apply, be approved, check out in seconds as opposed to minutes or hours.
Yeah.
And then there was this kind of recognition that we have all this data. Let's help people stabilize their financial life with these budgeting apps and so on. All of this, I think, is built to, at one point in time, chip away at what the ecosystem felt banks either weren't addressing or weren't very good at because they were bloated or they were bound by regulatory constraints that some alternative products might not be bound by. More recently, I think what you're finding is that finance can be, vertical finance is just, it can be embedded in so many places at so many different moments of intent. It can be embedded at Airbnb. It can be embedded in a transaction management system for real estate agents.
There's so many possible solutions everywhere, right?
So many possible solutions. And then what you're seeing is, and this is separate from crypto, but now because crypto is just, in many ways, it's either a store of value or it's rails or it's saving or it's trading. It's so many different things. But what I think you're now starting to see is this the data and the technology to decision, especially as it relates to credit and liquidity, and the ability to embed, I think you're going to start seeing digital wallets in many different ways.
Yeah.
I still think that, but I don't think that you're going to want a digital wallet for everything you do. I still think that those digital wallets attached to the flow of funds are going to be particularly powerful. And then you can look at your audience and your customer base and say, like, is this a group of people that would benefit from crypto? Is this a group of people that would benefit from super seamless low cost rails to transfer money back and forth? Do they need to do that? So I think we're going to see this. It was like this disaggregation from banks, and I think now we're starting to see this reaggregation. That's probably more appropriate and more customizable.
So yeah, I think you told me a statistic before about the percentage of what is actually fintech against larger financial institutions.
Yeah, it's probably a year old, but thus far, fintechs have really only cannibalized less than 5% of bank revenues,
which is crazy, right? There's so much potential.
It is so crazy because spending a lot of time in fintech, like it seems like there's so many companies solving so many big problems, but very, very early days. It's also a credit to the banks just how sticky and defensible those positions are. But there are a lot of smart people trying to chip away at that. I think over time we'll see more.
It's interesting. I wonder how long it'll take to maybe become more like 50-50. I wonder what the timeframes around that will be.
Probably a while.
Yeah.
Probably a while.
Okay. So sorry, I know we've not got bags of time left, but what advice do you have for, I guess, aspiring founders, specifically in fintech, that you'd give to people that are looking to start in the space?
Gosh, that's a great question, especially needing to give a succinct answer. I think the first is do it.
Yeah.
Try.
Just do it.
Think about put yourself in a mindset to identify problems in the world, and I think you're going to start seeing a lot of problems. Pick one that you're either passionate about or find people that you would love to spend more time with, and run at a problem. I just think that there are so many good things that come from trying to solve a problem, from leading something that will teach you a lot about yourself and hopefully, kind of improve the quality of life for whomever you're selling into. Also, it's just it's one of the most optimistic places I think you could build a career. Yes, it's hard.
Yeah.
But it's really, why do you keep doing it if you're solving problems every day? And I think that the people that you tend to surround yourself with that see the problems in the world and believe they're capable of making a difference, that's an inspiring place to spend time.
Yeah. Awesome. I love it. That's amazing advice. And thank you so much for your time. I really appreciate it. Great story. And I'm really excited to see where the future of Tongo holds.
Thanks, man. Me too.
Cheers.
Cheers.